thank you to the previous speakers. Very interesting and information-heavy presentations. So I'll try to take this a slightly lighter touch on the things that I will present. It's going to be sort of a helicopter view. And I will take the non-banking financial service provider perspective on all of this. And of course, this is a conference on AML, so most of my presentation will focus on that. But apart from that, I will also have an overview of risks that are at hand for all these institutions in general. So, yeah, oh, okay. Even though I was introduced, I would still like to say that I'm Darius Kulikauskas, head of Pervesk, an electronic money institution established here in Lithuania. We are actually a Lithuanian institution, so one of the few. There are not that many. We have a lot of foreign capital institutions which whom we compete. Now, I would like to start with textbook, so to say. I put that in quotes, risks faced by fintech companies. And what are those? So, of course, these are nothing new, and that's why I call them textbook risks, because in a way, these risks are also relevant for banks, entrenched financial institutions that have been operating for centuries, and so on. Our lives became digital not that long ago, but still we are already used to getting all the services delivered through digital channels. And what that means that we are all vulnerable to cybersecurity risks. And fintech companies are no exception. But for today, I would like to have an example which takes a completely different twist on this cybersecurity risk. Since we are talking about compliance a lot today, let's talk about Gdpr. So we had we as a world had a Black Hat event early this August in the US, where one PhD researcher who actually focuses his research effort on hacking satellites presented how one could exploit GDPR regulation to extract sensitive information from various companies. And this applies not only to financial technology companies, but everyone who processes data in the EU. So what he did, he actually impersonated his fiancée. He used only the knowledge of her name, surname, and email address. And of course, all that information for most of us could be obtained by guesswork or by basic Googling. So that's something almost a public domain. It's already available. Using that information, he just Googled email addresses of data protection officers at various companies, and just based on his guesswork, requested all of the information from that these companies possess about his fiancée, and he did that impersonating her. So he, in a way, exercised his right to his data. Well, the good news is that 40% of companies asked for strong authentication regarding his identity, so they either asked a very strict notarized copy of his passport, or something that would be difficult to obtain, or either asked to log into their systems and request the same information from within his account, well, from within her account in that way, for that matter. However, 25% of these companies handled the request without any additional questions. They just provided all the information available to them. So even though he initially used only the name, surname, and an email address, after his request, he was in possession of her maiden name, her school grades, all the email addresses that were entered into the system, purchase history, and whatnot. So this is a very sensitive information. Now, other companies asked for identification, but he was able to talk them down to a weak form of identification. He used bank statements that he borrowed from his fiancée. However, he covered intentionally a lot of information on those statements. And even then, for these companies, it was acceptable. So the result was that basically the majority of requests were handled and a lot of sensitive information was released. The last and very interesting part of this research was that 3% of his requests ended up in his fiancé's accounts deleted at those entities that received this request. At first it might seem funny, but actually this could be used as a different type of attack. You could deny a person his digital identity, his digital life, his digital accounts just by exercising rights set in Gdpr with incompetent, let's say, data protection officers. Yeah, so cybersecurity risk is a very broad topic, and I kind of deviated here. But other risks are more more related to the textbooks that I've mentioned before. And of course, fraud risk. Whenever there's finance, there's always going to be someone trying to steal credentials, someone trying to impersonate someone, just as that social engineering attack on Gdpr, it was also basically a fraud in a way. Of course, staff errors, malfunctioning of IT systems, these are risks that all fintech companies are susceptible because of their nature, because they operate with technologies. And of course, the classical risks that are relevant for any given entity, any corporation, so liquidity risk, settlement risk, and so on. This is not an exhaustive risk, just an example. However, I wouldn't say that for fintech companies, this is so simple. In reality, fintech companies, at least vast majority of them, are regulated and heavily regulated. Of course, the term fintech is very broad. It also encompasses a lot of software solutions that are only meant to be provided to financial firms, and the software itself is not regulated and so on. So just for the sake of simplicity, I will focus only on the licensed financial technology firms. And in Lithuania, at least according to the Bank of Lithuania, we have over 100 small fintech firms operating already here in Lithuania. And they face at least 12 legal laws that directly regulate their operations, which account to more than 250 pages if you put them in the same plain old boring Times New Roman and paste it into your word processor. The issue here is not the amount of pages, but the staff that works with these pages. Most of these companies are comprised of just from 3 to 6 individuals, and of course you can imagine that, you know, if you have 3 people employed in a company, so it's going to be a CEO, probably a financial officer, and someone who deals with operations. So they will share the burden of compliance among themselves. They will see this as an additional responsibility, but they will probably not have a dedicated person working with that. But yet still, that's not the problem. Even though I will name as the biggest risk for fintech companies compliance, this is a risk of failing to operate in a compliant manner, to put it simply. I would say that these firms are directed most of the time into wrong direction. A lot of the times, examples of incumbents or entrenched financial institutions are put forward as a very good examples and something that these fintech companies should follow. I mean, everyone working in the fintech industry probably has heard at one time or another, at least somewhere buried between the lines, that come on, these old banks, they have it all figured out. You have to copy them. You have to go after their methods. But in reality, I think the only possible way to have your compliance effective and efficient is to go after the individualized, tailored approach, which is in line with your business. So in other words, it's to apply risk-based approach. So for me, risk-based approach is something that encompasses this tailored approach, which is in line with every business model available. Now let me just quickly categorize possible approaches, how you as a fintech firm could solve these issues and how could you mitigate this risk. So at least at the very initial stage, you have two options. You can either hire a compliance consultancy firm or just physical people who consult you on these matters and ask them to prepare your internal procedures, rules, and everything that could be compliant. This is a very good option if you require speed, not the best probably option or not the optimal solution if you want that tailored experience that closely matches your business requirements. Another option is to create these internal procedures in-house and to grow the competence also in your company. This is a slow process. This does not copy existing procedures or rules. So this might be news to the regulator when you present that to your supervisory body. And you might also have to invest a lot of time in explaining what you're doing, explaining your technological solutions and things like that. So now let me turn to experience that we have witnessed at Pervesk. So first of all, of course, when you start the operations, probably it's always the case that the speed to market, we've all heard these terms, is a key priority. And we were no exception. We've turned to the consultants. And actually, we were rather satisfied with the outcome. We wanted speed. We got that. We wanted compliance with the existing regulation. We got that. However, it was, I mean, between those legal documents prepared for us, you could always get this feeling that, you know, this is a one-size-fits-all approach. It is ambiguous at some parts, you know, just to keep the document flexible enough so it can fit a fintech company and a bigger company, let's say a legacy institution. That's the reason why we opted for a hybrid approach. We had to face the inevitable conclusion that, you know, we have to build this in-house, and we used the result of our consultant efforts as a starting point, and we've started tailoring our procedures and rules to match what our actual business model suggests. So the outcome of that was that our procedures, while we still believe they are compliant, we have actually presented them to our supervisor. So, I mean, this is not just a guess. They became rather unique, less generic, which means they are less familiar to the regulator. And of course, it puts the regulator, let's say, in an inconvenient position. It's much more easier to supervise the whole industry if everyone has the same set of rules. But that goes against the risk-based approach. You cannot apply the same monitoring rules for a large bank that usually deals with customers physically and the same rules to a fintech company that does everything remotely without ever meeting its clients in person. However, going after this approach is costly because you do have to hire compliance staff, and while legal professionals, they are available in the job market, so to say. You can find them. It's not easy to find a lot of highly qualified and skilled AML officers that are just roaming around in the free and looking for a job offer. And the reason for that is that we have a lot of fintech companies in Lithuania. The number is constantly growing. We have large service centers that also increase their staff. So all the people with the right set of skills usually get hired very quickly, and everyone in this industry knows that the churn, how these people get transferred between different companies is very big. So it is not that really uncommon for someone in the EML team to get to work for the same company several times in over a year, because it gets to work, let's say, in Western Union for 6 months and gets transferred back to Danske for another 6 months and so on. Just because also these large service centers, they have to compete sometimes with the salaries and so on. And the issue is that, there is no silver bullet. Sometimes we get these sales pitch that you can just buy this or that technology and it will solve everything for you. But in the end, any technology, even machine learning or artificial intelligence, at this point is still just a tool that AML officers use. So that means that you still have to have a minimum set of employees at hand that monitor transactions, and some certain minimum actually exists for any given fintech company, despite the volumes that this company faces. So an auxiliary risk that actually stems out of this compliance risk is insufficient human resources. And this is probably, I don't know, maybe this is a global thing, but at least in Lithuania, when it comes to the AML officers field, AML officers profession, this is definitely a state of play right now. And no one actually, at least in formal education system, we don't have college degrees or something, that would prepare officers to work with money laundering or terrorist financing risks. So private sector companies, they have to train these specialists themselves. And I think that the speaker after me will talk about this topic extensively, so I will not go into detail here a lot. So having heard that, this is one of my summary slides, and I'm looking at the clock. I'm so happy that I managed to squeeze everything in time. So having said all that, I think it's very important that the regulator puts himself in this out of his comfort zone and allows for divergent, varying risk models and sets of rules to be applied across the industry. Of course, supervision will become hard because of that, but I think in the end, the goal to prevent money laundering and to prevent terrorist financing will be achieved as, if you have everyone playing by the same rule book, which is ignorant to your business model, you will end up with an unintended consequence that you are very predictable, and despite facing, say, very high risk profile customers, you will apply risks that are only sensible in a low risk environment. So just a few words to sum everything up. So I believe that for non-banking financial service providers, compliance risk is the biggest risk, and as an auxiliary risk is insufficient human resources in the area that would actually help to plug the gap in this area. And yeah, there is no silver bullet. So we as an industry, we have to train our AML specialists, and I think that's where a lot of our investments go these days. Thank you.